Through CPI, through the Fed, we can see how the S&P responded. It didn't actually respond that bad. And frankly, if you look at some of these levels, for example, the gap fill, all we did was fill the gap. Now, he did talk about leaving the door open for more rate hikes, and he doesn't know if February would be 25 or 50. I don't view that as the end of the world here. I actually like how we came down here and gap filled and retested and closed above it. Now, if you look at something as VWAP, subscribe to the channel, make sure you hit all notifications because we're going live a lot now. And I'm also putting updates and updated charts during the day into the community feed, and you will only get access to those if you are subscribed to the channel. Now, you see VWAP, and I have two standard deviations on either side of them. You can just see how we just kind of hung in there today, and then the news hit. We sold down, but we didn't really go anywhere. We just filled the gap from 2 days ago. So if somebody was going to tell you that the market's going to be exactly where it was Monday at the close, you probably would not have a real problem with that, considering you just went through CPI, which quite frankly was very good. And then you had a lot of people buy at the wrong time. And then you can kind of see they're kind of hoping a little bit, right, that they're going to be okay. And then we know how the hoping works. That never really works, does it? And then the end of the day comes in, and then you just get the kibosh. And that's exactly what happened here. Now, you form a little pattern, and I think this is really important. So you can see on the second standard deviation VWAP how you couldn't get through it. And then when you did, you flipped. So just a little quick tip. Sometimes you can use standard deviation VWAPs. When you flip back into them, they work just like Bollinger Bands. They're actually set the same way as Bollinger. See how you're holding in here, and now you have that H, and now you're breaking down a little bit right here. You never confirmed that H, and you had every reason to sell down. He basically came out and was saying he doesn't really know if there's going to be a recession, how bad the recession is going to be. He is very worried about the labor market, and I think that's a really valid point. But we have some developments here, and I don't think that we should ignore them. So the very first thing is, obviously, we can all see that the 55-day moving average is curling up, very similar to what it did here before it reversed back down after breaking, after failing at the 200. And I just want to point this out. Here's your death cross. Once you have a death cross, your resistance usually does become this 200 until it doesn't. And then usually you see a golden cross down the line. They don't always work, but if you are crossing up like you are right now, you will eventually collide with the 200-day. Now, why is that important? Well, it's important for a couple reasons. Right now, on average, the 55-day moving average is moving about 50 cents a day upwards. And that's based upon this just staying stagnant. So let's go on the premise and say that stays stagnant. Within about 20 days, you're going to be up about 10 points roughly, right? It's a little more complicated than that, but to get an understanding, this is where you're going to be within 20 business days, right around January, and you're still going to have this declining slope of a 200-day moving average. I think that's really very important to understand, that all we have to do is go flat. So now we drill into this technically. We have the CPI behind us, which was a great number for the market. There's no doubt about it. And we have the Fed behind us. And we have the Fed doing something that they are admitting that, okay, we need to slow down. That type of turn needs to be taken into account. I'll show you why in a moment. If we can just stay in here, we really did not go anywhere. We just basically filled the gap in. If we compare where the 55 was to the 200, you can see a move of about 8%. So we had an 8% differential between the two. Now that differential is substantially less. So what does that mean? Well, that means we're getting tighter and tighter, and we're consolidating, and the probability of a change in trend is more than likely. That's how I view it. Now, that doesn't mean it's going to happen. That doesn't mean that we don't come back and retest 383. If we were going to sell down, we did not collapse after CPI, which was good. We did not collapse on the Fed. What is going to be the driver that's going to drive the market down? And all I see right now is an index that is locked right in here and not really going anywhere. And we're all trying to figure out where it's going to go next. Well, it's very possible that we just stay in this range for a couple weeks and these averages start catching up which is just buyers, and then start turning. These three arrows mark when we started getting signals from the Fed that they were going to have a change in policy. Since this transpired, we had the dollar that actually rallied substantially, and we had a massive sell-off in the bond market that we haven't seen for about 40 years. This was all based upon change in policy. What we're seeing is we're seeing a change in policy unfold right in front of us. In other words, we've gone from 75 to 50. And what people and the pundits keep saying is, well, we're going into a recession. We don't know that. Since this date, which was a CPI number, of course, these are all CPI numbers right here as well. This gap up as well. CPI was a gap up that faded. All the data that's coming out is driving the equity markets higher. While the data of CPI is driving the equity markets higher, they are changing their tune on rates, and they are starting to admit that they have to slow down. Now, no two time periods are ever alike, but what we can do is we can look at past and then get an understanding of what could happen. This was during Greenspan, and Greenspan was raising rates. So Greenspan raises rates here, Greenspan raises rates here. The difference between these two moves was 50 basis points to 25 basis points. This was his last rate hike. By June, he was cutting rates, and this led to a massive multi-year rally. What I'm pointing out is that when you have a change in trend, do not fight the Fed. 2022, we fought the Fed the whole way down, waiting for it to turn, waiting for it to turn. Right in front of our eyes, we're seeing a change in policy. I can prove it. This is the US dollar during 1995. You can see it did nothing but trend down at the same exact time that the market went higher. Matter of fact, it never got back to that break even of 1995 till about 1997. This is the dollar today on a daily chart. And you can see how we broke our upper trend line and are cracking. Zoom out on the monthly, and you can start seeing the same pattern develop on the dollar that happened in 1994-95. Here is the 10-year Treasury in 1994. You can see how we went from a 560 all the way up to about an 820. Obviously, this move was stronger based upon the percentage basis, but you get the idea. Look when it turns, right? Right around December, right around his last rate hike. We had one more rate hike, February. And then after that, we started cutting. Bond market started coming in. Here's the 10-year. Here's the turn. You can see right where these rate hikes or data came out. Here we are on the monthly. Does this look familiar where you're starting to see this start to turn down? So before we just assume that we're going to roll down and take out new lows, it's important to look at past performance of a similar situation. Is it exact? No. Is inflation higher now than it is then? Absolutely. And there are obviously other factors to take into account. But you need to take a look at what's going on and not just expect this huge run up, which is what we're seeing. Take a look at some of the leading stock. NVDA. Note the difference between August, the 200-day in here, and note the closeness that you are now here. Just so we're clear, this is the closest we've been to these two lines since we rolled back here. Now, this has a ways to go before it becomes what we would refer to as a golden cross. Could be a couple months from now. But NVIDIA had every reason to break down today. Every reason to get below that 200-day moving average, and it didn't. So that gives us a really good spot to watch this and see if it breaks under and then see how it acts. The indexes are giving us that same level, but let's take a look at Microsoft. Here's your 200-day moving average on Microsoft. You had every reason to break down. CPI is behind us, Fed is behind us. Instead, we get a long-legged doji. For those that have been following for some time, long-legged dojis are a sign of uncertainty. So when this flips, we have our short-term direction. Here you are at the 200 up here. Here's where the 55 is. So you have a similar situation, but there are some differences. These bars are getting longer and longer, and you're having wider swings than you were having up here where everything was tighter and tighter. This usually signifies a change in trend. So I wanted to spend some time just getting people to think a little differently instead of just giving ideas, because again, you are in one big trade. I don't want you to think that any of us have any idea on what exactly is going to happen. I mean, it's the one thing I will really speak very highly of with Powell today, that he actually came out and said that that he does not know if there will be a recession, what the recession will be like, because none of us know what's around the corner. What I'm simply saying is that if we use our brains and just look at price action, we had every reason to break down here today. Every reason for the sellers to sell and every reason for the people that bought to panic and just say, get me out, it's over. And that's not what happened. Instead, we hung right in here and right against where we were Monday at the close. As always, please comment on this video. That's why I spent a lot of time on the comparison. I've seen a lot of people putting out data saying that when you see these change in trends, it's very bad. Fed pivots are bad for the market. It's just not accurate. It's not an accurate statement. If you are interested in the trading community, there is a link up here in the top right. Simply click the link and you will be added to the wait list.